Namaste. Telugu Prajala Mana Sakshi Sakshi TV. I am Swarna. Welcome to Fun Factor Show. Today, I'm pleased to once again welcome Shrinivas Penugonda and Mr. Ken Kate from Next Level Financial Advisors at Ameriprise Finance for the third installment of our multi-show series on finance for immigrants in the USA. Shri and Kent have been acting as our resident experts on financial planning for investing for these financial shows, and today our topic is the market outlook for the second half of 2021. Before we begin the show, if you are CPA and would like to join our special Fun Factor talk show, please email us at usa@sakshi.com or call us at 866-725-7441. Before we begin the show, please note down the information provided in the show is not legal advice. Use of this content is for general information purpose only. Sakshi TV or its agents in USA or guests in our show are not responsible for this information as a legal advice. If you need any specific information, please contact CPA directly. Without any further delay, let's start our show by welcoming Shri and Kent. Hi Shri, hi Ken, how are you?
Doing wonderful. Nice
Good,
to see
thank
you
you.
again.
Welcome to the show.
Thank you.
So, to get us started on what to expect in second half, perhaps you can review us for what has happened so far in the first half of 2021.
Well, in the first half of the year, the markets kind of were volatile. In the January, the markets were down. February, markets really went up. And in March, April, they kind of went up again, came down, and it was very volatile. It's all because of the yield on the 10-year Treasury. Because when we started the year, the yield on the 10-year Treasury note was 75 basis points, and it kind of jumped to 1.75. And when the interest rates go higher, the future cash flows of the growth companies will be lower. So based on that, we have seen some of the NASDAQ stocks or growth stocks pull back 20, 30, 40%. For example, Tesla, which was like $900, went as low as like $480, $500. So some of the growth stocks really took a big hit.
I'm going to share a slide with you that really sort of illustrates what he's talking about. This is the first 6 months of the year. And he was talking about the market went up, the market went down, the market went up, the market went down. And you can see how the market was really trying to find its feet. What it was really doing is there was this great shift going on. Technology, the stocks that are most affected by that interest rate rising that he was talking about, those technology stocks were getting crushed and losing enormous amounts of value, as he talked about, some of them 40% and more. Well, the market didn't lose 40%, right? What was happening is it was shifting from the technology to value. And if you own the value portfolio, it's one of the portfolios we run, it was zooming higher while the market couldn't find its foot. Interesting thing about this chart, there's a few things you can look at here that really highlight what's happening. You can see where the market went up, had a correction, went up and made a higher high, and then it dropped back down almost to where it was before, not quite, kept going up, and then it really landed hard, almost back down, but not quite, and then kept going up. On the bottom, you can see there's already a line drawn. That rainbow line right there is following the lows. The lows were almost as low as the previous low, but they were always a little bit higher. That setup, higher highs and higher lows, as you're working through that cycle, creating that channel that's pointing higher, that is usually a setup for a big move higher in the market. And we saw it right there at the beginning of April. It just zoomed up here. And that's when we entered this channel, right between the gold bars there. For the last 3 months, this is, the very beginning of April, all of May, almost all of June. And at the very end there, you can see here's a big blue arrow pointing at where we broke out. And for the last few, it's only been a few days, that was last week.
Yeah.
And so for the last few days, just like this move higher, now we're seeing this move higher, and we're going to look for the new range. That new range might start right here, or it may keep going, and we're going to have to find out where this new range wants to establish itself. But it's certainly been an interesting 6 months. For the first half of the year, I think the second half could be just as interesting.
Well, Swarna, I think the first half of the year, the overall general market had a good move. So we had a return of about 14.2% on the S&P, which is very fairly strong. Although the parts of the market, like for example, the growth stocks were down like almost 15 to 20% in February. But some of
the recording has stopped.
But some of the sectors that were not loud in 2020, like energy, financials, materials, they did extremely well. And the energy sector was the best performing sector, up like 48% in the first half of the year. So some of the sectors which did not do well, they did extremely well. And also, I think there was like a rotation kind going in from the growth to value. So from technology into...
Yeah, that's exactly what happened in the first half of the year. In the second half of the year, we're really setting up for something different, which I think will be interesting.
Mr. Sri and Ken, before we talk and discuss more, we have a caller, Zanadia from Pennsylvania.
Fantastic.
Hello, Sri, Keith, this is interesting. I just wanted to find out from you, your view. This is a twofold question. One is that the markets are continuously going up, coming out of the pandemic, and the inflation looks, fairly, that's also going up. I know Federal Reserve is really putting a lot of liquidity here. And in addition, the housing market is really, sizzling. So what do you think in the next 6 months to a year? What is your view? What is the impact of such a situation going forward? The second question is that the Bitcoin is really skyrocketing. Several companies like MicroStrategy, other companies have really took a big stake in this. The question is it stable? What is the impact of big companies of US taking a part of this process? Thank you.
Well, let's look at the first part of the question, Vijay, and that is, given the inflationary concerns, the interest rate concerns, where do we expect the markets to be in the second half of the year? Well, as I said, we had a very strong first half. Markets have been up 14.2%. And when we have such a strong first half, I believe the indexes will do better in the second half with an average return of about 7%.
Was this question specifically about inflation? Was that what he was asking, Shri?
Well, he was asking with the concern about inflation, with the concern about interest rates, where do you expect the markets to be in the second half?
So, yeah, I would add that the billion-dollar question, billions of dollars question is, is this inflation transitory or is it permanent? And so far, the Fed and many experts are saying transitory. There's certainly another view. There's a lot of people out there thinking there's no way you could sink this much money with all of the stimulus and the rest of it into these markets and not have more permanent inflation, not just a small thing. But the reason people think it can be transitory and not such an important piece of the puzzle right now is because our market, our GDP has been severely reduced. People have been out of work and on government stimulus, and inflation, although higher than it was 6 months ago, is extremely low. And so an inflationary move from sub 1 to plus 1 is significant, and yet, we're well below target, and in my view, unlikely to go past it as people, this sort of boom of reopening is going to slow down. So as the boom slows down, inflation subsides, and we'll see where this inflation goes. But I think we're both calling for a higher next 6 months.
But I think going back to the question, with the recent numbers coming in, although the numbers show the inflation is high, but the markets kind of, I think, factored in already the inflation, and it kind of actually the interest rates have gone down in spite of higher inflationary numbers. So I think market has already factored in higher inflation coming in. But like I agree with Ken that the inflation is transitory, because I think the supplemental unemployment benefits are going to run out in September, and then the other catalyst is people who have forced savings of about $2 trillion, they are going to spend the money, and we are back to normal after that. So I think definitely inflation is transitory. But going back to your question, Vijay, is I think there are 4 factors that could have a negative effect on the market, which no one has a handle on. I think one is the tapering discussion, when the Fed is going to taper their bond buying program. And I think the second one is, like as you said, the inflationary pressures. If the inflation continue to go higher, then the Fed may have to step in and start increasing the interest rates. And I think the third factor is the margin pressures, because as the costs for inputs are increasing, I think there is margin pressure on earnings, because the corporations have only 2 choices: either pass it on to the consumer or increase the prices. So I don't think we are in an environment where they can increase the prices. And I think the final thing that could have a negative effect is the taxation, because the Biden administration is talking about higher corporate taxes and higher individual taxes and higher capital gains taxes. We don't know how it is going to pan out, but I think at the end of the day, those are some of the negative events that could put a damper on the market move upside. But again, like as I said,
I would push back on some of that, right? Yeah. And so we don't necessarily agree. The screen you're seeing is about personal savings, right? Through this pandemic, we have had huge skyrocket in the amount of savings people have, right? And the other inflationary, and so ultimately, I'm pushing back on your idea that corporations can't raise prices. I think they can. Now that's inflation, right? All of a sudden things are getting more expensive, but people can afford it. There's some money out there. Now, this is assuming everybody gets back to work.
Yes.
But even while they're not working, thanks to stimulus, people have money in their pockets. And so you can see that they're saving it and they're going to be ready to spend it. This is this boom in inflation that then, as you said, can tamper back down. And this other piece that we were looking at is just how huge this
I'm sorry. We have another caller, Venkat from Pennsylvania.
Okay, let's take the question. I'll finish my point here is simply that part of this inflationary discussion in red, you can see this huge stimulus package that has happened. In blue is what we did during the financial crisis. Red is what's happening now, more than twice. And so that's a lot of money in the system, but we're going to start tapering it out. Prices will rise, but I don't think it's economy crushing type of inflation.
Swarna, can I take the second part of the question before we go to the second caller?
Yeah, sure.
Okay. The question on the Bitcoin is, I think, yes, companies like MicroStrategy or Tesla have invested in Bitcoin. I think, like how bonds act as an asset allocation tool. So people are using Bitcoin as an alternate asset. Do you agree with me?
I agree, and yet part of his question was, is it stable? And the answer is no, it is not stable. That's perfectly clear, right?
Right. Yeah,
And
we have seen it going to 65,000 3 weeks back, and now it's about 36,000.
You cannot look at it as a bond. Alternate asset class,
Right.
yes, but a highly unstable asset class. And so, in my opinion, you can look at Tesla investing in Bitcoin and say, well, if they can do it, shouldn't I be able to do it? I'm saying if you're a speculative investor, if you're investing in Bitcoin, either that or you're in for the very long game, and I mean decades. And so I for us, we're not investing in Bitcoin.
No.
Because that's not how we're building wealth for the future, right? We can understand the stock market, we can understand PE ratios, but it's very difficult to understand the movement on Bitcoin because it's largely speculative. And with that, perhaps we should take another call.
Yes, we have Venkat from Pennsylvania.
Yes, thanks, Aparna, for taking my call, and I would like to appreciate Shri and Kent for giving outlook on the market. So my question is about the real estate prices, like housing prices in India. As you know, Shri and Kent, the real estate market exploded here in US with prices going up like 20%. Or even more, including there is a bidding wars going on both in the existing existing home sales and also including the new markets as well. So in the second half, I know the COVID vaccine is still in there in India. So do you think once the vaccination rate goes up in India, the real estate market is going to repeat what we are seeing here in US? And so that's the main question. And I have another second question. I'm sorry for giving a second one as well. I have a question about the commodity prices in the second half. Like the oil and copper prices went up so much in the first half. So what do you think in the second half, especially in the US? Both for the oil and copper prices based on the EV market and other things for the copper. Thank you for taking my question.
I have a view about our real estate in the second half. I'm unclear about how that's going to translate to the Indian housing market. Mm-hmm. Do you have an opinion about that?
Well, I'm not much familiar with the Indian market, but we can talk about the US market.
So let's talk about that a little bit, and then you can perhaps extrapolate what I'm saying based upon what you know about the Indian housing market. We've had these, as you say, extreme demand for housing, very little supply. People can't find houses. When they finally find a house, as you described, there's big bidding wars. Almost every house goes for more than they're asking, and very quickly. And so you're saying, okay, there's a real estate boom going on. Those end, right? And sometimes they end very badly. So if that's the case, is it about to end very badly? My answer is, I'm not so sure it does this time. And we have many clients, we have this discussion all the time, who are saying, well, I want to sell my house because it's at a very high level, but I don't really, I need a place to live, but I don't want to buy a house at such a high level. It's very hard to buy a house, and I feel like I'm paying too much. But the thing that's happening in the US, and you'll have to decide if it's happening in India, but in the US, we have the largest generation who's ever existed in the millennials. They have been late to family formation. They stay single longer. And for a long time, people were saying, these millennials, they're never going to get married. They don't want to have kids. They just want to take all their money and travel.
They were postponing any commitment.
And it has turned out that it's not true. It's not that they don't want to have families and children. They've just postponed it. And so now the first millennials are rushing into housing, family formation and housing. But there is a huge amount of millennials behind them who are going to keep coming and coming. And so there's an argument that says, we don't have to have a crash anytime soon. And if you think you're going to sell your house, sit on your money for a couple of years and wait for the downward crash before you buy, you may just be sitting on your money. And in fact, those housing prices keep increasing and getting more expensive. And, you know, just like we're always talking about, just because the stock market's expensive doesn't mean it can't get more expensive. I think the housing market might be in that cycle here in the US.
Right, yeah, I agree with you, because I think this is a multi-year cycle for the housing market. And again, you know, it is all supply and demand. And I believe on average, the inventory is about 5 million units, and we are short of about 1.5 million units. So it will take builders quite a while to come up with that supply, and there is not much of existing homes for sale. So the demand is going to continue. But I think the negative catalyst for the housing market is if the interest rate starts going higher, and as the mortgage rate starts going higher, I think that will put a damper on the housing market.
That's the X factor. So it all comes back to inflation anyway. So if we find out that we're wrong, inflation's not transitory, and it has happened at least once before when we were wrong. So it's possible that we're wrong on inflation. And if that happens, and you know, mortgage rates are spiking, well, that just makes it more and more difficult for families to get into housing. And so it will definitely put a damper. It can put screeching brakes. If inflation went runaway inflation, we'd be in trouble. And you'd probably see a sort of recessionary environment because it's going to affect everything.
Correct.
It'll affect the stock market, it'll affect the housing market. But we're still in the boat that that's not in the cards. So is the Federal Reserve, by the way. So we have good backing.
And the second question was?
Swarna?
I'm sorry, I got you.
It was.
I was impressed by your answer and the way you are explaining. I forgot the second question.
Okay. So that's all right.
No, he was asking about the commodity prices.
Commodity prices. Okay.
Yeah.
Which is all tied up with
It's
this.
all tied up, the oil. I think the oil prices are going to go higher because the demand is coming in with the reopening. And again, you know, as you see, India is still under Delta variant, and there's still some states which are under lockdown. So as they open up, the demand for energy increases, and people have a pent-up demand to travel. So I think demand for energy goes higher, and they're talking about $100 a barrel. So I think, you know, the prices are going to go higher. And then coming to copper, I think his question was on copper. Electric vehicles use 6 times more of copper than a traditional combustion vehicle. So I think there's going to be demand for
and all the housing. You know, we're talking. It ties into the housing. It ties into the reopening.
Yes.
It ties, you know, and just inflationary trends. These are the inflationary trends. In my view, is that there's going to be pressures on these commodities as we reopen and businesses. You know, factories get back to work and,
Yes.
and businesses get back to work. The technology companies, are back to work,
Yes.
but builders are trying to hire, the service sector is trying to hire, and commodity prices, lumber prices were the biggest inflationary problem they had on the building side because supply was just non-existent. You couldn't get lumber. And when you got the lumber, it was extremely expensive. But in the last 30 days, those lumber prices have collapsed because the suppliers are catching up, flooded the market. Housing will take longer, but it's happening. Here in the US, you've got huge builders like Pulte and Toll Brothers, and they are building. So they're taking advantage of what's happening in the market right now. So supply will come back.
Yeah, supply is coming
And
in.
that's when things are going to sort of slow down.
Right.
But I don't think that means housing crash. I think it means mitigation.
Awesome. So thank you so much for your time, Mr. Kent and Mr. Sri. That's all we have for today, folks. So stay tuned for more information. In the meanwhile, if you have any questions, please send them to usa@sakshi.com or call us at 866-725-7441. I hope it has been an informative session to all our viewers. I'm Swarna signing off. Telugu Prajala Mana Sakshi, Sakshi TV. Namaste.